Good morning, students. In this video, we are studying about the financial statements. So, this is our video number 5th. A financial statement is a collection of the data organized according to logical and consistent accounting procedure. Its purpose is to convey an understanding of some financial aspects of a business firm. It may show a position at a moment in time, as in case of balance sheet, or may reveal a series of activities over a given period of time, as in case of income statement. Thus the term financial statement generally means two statement. The number one is position statement or the balance sheet, and the number two is income statement or profit and loss account. These statements are used to convey to the management and other interested outsiders the profitability and financial position of a firm. Financial statements are the outcome of summarizing process of accounting. In the words of John N., financial statements provide a summary of the account of a business enterprise, the balance sheet reflecting the assets, liabilities, and capital as on a certain date, and the income statement showing the results of operation during a certain period. Financial statements are prepared as an end result of financial accounting and are the major sources of financial information of an enterprise. Smith defined financial statement as the end product of financial accounting in a set of financial statements prepared by accounting of a business enterprise. Next is objectives of financial statements. Financial statements are the sources of information on the basis of which conclusions are drawn about the profitability and the financial position of a concern. They are the major means employed by the firm to present their financial situation of owners, creditors, and the general public. The primary objective of financial statement is to assist in decision making. The Accounting Principle Board of America (APB) states the following objectives of the financial statements. Number 1, to provide reliable financial information about economic resources and obligations of a business firm. Number 2, to provide other needed information about changes in such economic resources and obligations. Number 3, to provide reliable information about changes in net resources arising out of business activities. Number 4, to provide financial information that assist in estimating the earning potentials of business. Number 5, to disclose to the extent possible other information relates to the financial statements that is relevant to the needs of user of these statements. Next is type of financial statement. Financial statement mainly comprise of two basic statement: position statement or balance sheet, and number 2, income statement or the profit and loss account. However, generally accepted accounting principle, which is called as GAAP, specify that a complete set of financial statement must include a balance sheet, an income statement, a statement of changes in the owner's account, a statement of changes in the financial position. So let us discuss balance sheet. American Institute of Certified Public Accountant defined balance sheet as a tabular statement of summary of balances carried forward after an actual and constructive closing of books of accounts and kept according to the principles of accounting. The purpose of balance sheet is to show the resources that the company has, that its assets, and from where these resources come from, that is its liabilities and investment by owners and the outsiders. The balance sheet is one of the important statements showing the financial strength of concern. It shows on one hand the property that it uses and on the other hand the resources of those properties. The balance sheet shows all the assets owned by the concern and all the liabilities and claim it owns to the owner and the outsider. The balance sheet is prepared on a particular date. The right hand side shows the property and assets. Normally, there is no particular sequence for showing the various assets and the liabilities, and the Companies Act 1956 has prescribed a particular form for showing assets and the liabilities in the balance sheet for companies registered under this act. These companies are also required to give figures for the previous year along with the current year figures. Second is income statement, which is also called as profit and loss account. Income statement is prepared to determine the operational position of the concern. It is situated of revenue earned and expenses incurred for earning that revenue. If there is excess of revenue over expenditure, it will show a profit, and if the expenditure are more than the income, then there will be loss. The income statement is prepared for a particular period, generally a year. When income statement is prepared for the year ending on 31st December 2007, then all the revenue and expenditure falling due in that year will be taken into account irrespective of their receipts or the payments. The income statement may be prepared in the form of manufacturing account to find out the cost of the production, in the form of trading account to determine the gross profit or gross loss, in the form of profit and loss to determine the net profit or net loss. A statement of retained earnings may also be prepared to show the distribution of profits. Third, statement of changes in the owner's equity, which is also called as retained earnings. The term owner's equity means claims of the owners of the business, that is shareholder, against the assets of the firm. It consists of two elements. Number one, paid up capital, that is initial amount of the funds invested by the shareholder. Second is retained earnings or reserve or surpluses, which means undistributed profits. The statement of changes in the owner equity simply show the beginning balance of each owner's equity account, the reason for increase and decrease in each, and its ending balance. However, in most cases, the only owner's equity account that changes significantly is retained earning. Hence, the statement of changes in owner's equity becomes merely a statement of retained earnings. A statement of retained earning is also called as profit and loss appropriation account or income disposable statement. As the name suggests, it shows the appropriations of earning. The previous year balance is first brought forward. The net profit during the current year is added to this balance. On the debit side, appropriations like interim dividend paid, proposed dividend on preference shares, equity share capital, amount transferred to debenture redemption fund, capital redemption fund, general reserves are shown. The balance in this account will show the amount of profit retained in hand and carry forward. The appropriations cannot be more than profit, so this account will not have a debit balance. There cannot be appropriations without profit. Fourth is statement of changes in financial position. The basic financial statement, that is balance sheet and the profit and loss account or income statement of a business, reveal the net effect of various transactions on the operational and financial position of the company. The balance sheet gives a static view of the resources of a business and the uses to which these resources have been put at a certain point of time. The profit and loss account in a general way indicate the resources provided by the operations, but there are many transactions that do not operate through the profit and loss account. Thus, for a better understanding, another statement called statement of changes in the financial position has to be prepared to show the changes in assets and the liabilities from the end of one period to the end of another point of time. The objective of this statement is to show the movement of funds during a particular period. The statement of changes in financial position may take any of the following two forms: fund flow statement and cash flow statement. The fund flow statement is designed to analyze the changes in the financial position condition of a business enterprise between two periods. The word fund is used to denote working capital. This statement will show the sources from which the funds are received and the uses to which these have been put. This statement enables the management to have an idea about the resources of funds and their uses for various purposes. This statement helps the management in policy formulation and performance appraisal. Second is cash flow statement. A cash flow statement in the financial position of a firm on a cash basis is called cash flow statement. It summarizes the causes of changes in the cash position of a business enterprise between the dates of two balance sheet. This statement is very much similar to the statement of changes in the working capital, that is fund flow statement. A cash flow statement focus attention on cash changes only. It shows the sources of cash and its uses. Next is uses and importance of financial statement. Financial statement are mirror which reflects the financial position and operating strength or weakness of the concern. These statements are useful to the management, investors, creditors, bankers, worker, government and the public at large. So George O point out the following uses of financial statement. So the utility of financial statement to different parties are: first, use to the management. The financial statement are useful for assessing the efficiency of different cost center. The management is able to exercise cost control through these statements. The efficient and inefficient spots are brought to the notice of management. The management is able to decide the course of action to be adopted in the future. Creditors. The trade creditors are to be paid in a short period. This liability is met out of current assets. The creditor will be interested in current solvency of the concern. The creditor will be interested in current solvency of the concern. The calculation of current ratio and liquid ratio will enable the creditor to assess the current financial position of the concern in relation to their debts. Next is banker. The banker is interested to see that loan amount is secure and the customer. Investors. The investors include both short term and long term investors. They are interested in the security of the principal amount of loan and the regular interest payment by the concern. The investors will study the long term solvency of the concern with the help of financial statements. The investors will not only analyze the present financial position but will also study future prospects and the expansion plans of the concern. The possibility of paying back the loan amount in the face of liquidation of concern is also taken into consideration. Next is government. The financial statement are used to assess tax liability of business enterprise. The government study economic situation of the country from these statements. These statements enable the government to find out whether business is following various rules and the regulations or not. These statements also become a base for framing and amending various laws for the regulation of business. Next is trade association. So the association provides services and protection to the member. They may analyze the financial statement for the purpose of providing facilities to these members. They may develop standard ratios and design uniform system of accounts. Next is stock exchange. The stock exchange deals in purchasing and sale of securities of different companies. The financial statements enable the stockbroker to judge the financial position of a different concern. The fixation of the prices for securities is also based on these statements. Next is limitations of financial statement. Number one, only interim reports. So do not give exact position, historical cost, impact of non-monetary factors ignore, no precision. So all these are the limitations of the financial statements. So number one is only interim report. These statements do not give a final picture of concern. The data given in these statement is only approximate. The actual position can only be determined when the business is sold or liquidated. However, the statement have to be prepared for different accounting periods, generally 1 year during the lifetime of the concern. The cost and income be apportioned to different periods with a view to determine the profits. The allocation of expenses, incomes will depend upon the personal judgment of the accountant. The existence of contingent assets and the liabilities also make the statement imprecise. So, the financial statements do not give the final picture and they are at the most interim reports. Second is do not give exact position. The financial statements are expressed in the money value, so they appear to give final and accurate position. The value of fixed assets in the balance sheet neither represents the value for which fixed assets can be sold, nor the amount which will be required to replace these assets. The balance sheet is prepared on the presumption of going concern. The concern is expected to continue in future. So the fixed assets are shown at a cost less accumulated depreciation. There are certain assets in the balance sheet such as preliminary expenses, goodwill, discount on issue of shares, which will release nothing at the time of liquidation, though they are shown in the balance sheet. Next is historical cost. The financial statements are prepared on the basis of historical cost or original cost. The value of asset decrease with the passage of time, current prices changes are not taken into account. The statements are not prepared keeping in view of present economic conditions. The balance sheet loses the significance of being an index of current economic realities. Similarly, the profitability shown by income statement may not represent the earning capacity of the concern. The increase in the profit may be due to an increase in the prices or due to some abnormal causes and not due to increase in the efficiency. The conclusion drawn forms financial statements may not give a fair picture of the concern. Impact of non-monetary factors ignore. There are certain factors which have a bearing on the financial position and the operating results of the business, but they do not become a part of the statement because they cannot be measured in money terms. Such factors may include reputation of management, sources and commitment for the purchases and the sale, cooperation of the employees. The financial statement only show the position of the financial accounting for business and not the financial position. No precision. The precision of financial statement data is not possible because the statement deals with the matter which cannot be precisely stated. The data recorded by conventional procedure follow over years. So various convention postulates, personal judgments are used for developing the data. Next is financial statement analysis. So the term financial statement analysis is also called as financial analysis, and it is analysis and interpretation of financial statements. So it is a process of determining financial strength and the weakness of the firm by establishing strategic relationship between the items of balance sheet, profit and loss account and other operative data. The purpose of financial analysis is to diagnose the information contained in financial statements so as to judge the profitability and financial soundness of the firm. Just like doctor examine his patient by recording his body temperature, blood pressure before making his conclusion regarding the illness and before giving his treatment. A financial analyst analyzes the financial statements with various tools of analysis before commenting upon the financial health or weakness of an enterprise. The analysis and the interpretation of financial statement is essential to bring out the mystery behind the figures in financial statement. Financial statement analysis is an attempt to determine the significance and the meaning of financial statement data so that forecast may be made of the future earnings, ability to pay interest and the debt maturities, and profitability of sound dividend policy. So now there are different types of financial analysis. So there are six, seven to eight analysis: external analysis, internal analysis, horizontal analysis, vertical analysis, cross-sectional analysis, time series analysis, long-term analysis. So number one is external analysis. This analysis is done by outsiders, which who do not have access to the detailed internal accounting records of the business firm. These outsiders include investors, potential investors, creditors, potential creditors, government agencies, credit agencies, and the general public. For financial analysis, these external parties to the firm depend almost entirely on the published financial statements. External analysis serves only for a limited period. However, this recent changes in the government regulations requiring business firms to make available more detailed information to the public through audited published accounts, which have considerably improved the position of external analysis. Second one is internal analysis. The analysis conducted by a person who have access to the internal accounting records of a business is called as internal analysis. Such analysis is performed by executives, employees of the organization, as well as government agencies which have statutory power with them. So financial analysis for managerial purpose is the internal type of analysis that can be affected depending upon the purpose to be achieved. Next is horizontal analysis. Horizontal analysis means comparison of financial data of a company for several years. The figure for this type of analysis are presented horizontally over a number of columns. The figures of various years are compared with the standard or base year. A base year is a year chosen as a beginning point. So this type of analysis is called as dynamic analysis, as it is based on the data from the year to year rather than on data of any one year. The horizontal analysis make it possible to focus attention on the item that have changed significantly during the period under review. Comparison of an item over several period with the base year may show a trend developing. Next is vertical analysis. So vertical analysis means the study of relationship of various items in the financial statement of one accounting period. In this type of analysis, the figure from the financial statement of a year are compared with the base selected from the same year statement. It is called as static analysis. Common size financial statement, financial ratios are the two tools which is used in the vertical analysis. Since vertical analysis considered the data for one time period only, it is not very conducive to a proper analysis of financial statements. However, it may be used along with the horizontal analysis to make it more effective and meaningful. Cross-sectional analysis. Cross-sectional analysis involve comparison of financial data of a firm with other firm or industry average for the same time period. Time series analysis. Time series analysis involves the study of performance of the same firm over a period of time. Next is there are two types of more analysis: short-term analysis and long-term analysis. Short-term analysis measure the liquidity position of a firm, that is short-term paying capacity of the firm or the firm ability to meet its current obligations. Long-term analysis involve the study of firm's ability to meet interest cost and the repayment schedule for its long-term obligations. The solvency, stability, profitability are measured under this type of analysis. Next, we are going to discuss various methods and the devices available for the financial analysis. So there are six methods. Number one is comparative state analysis. Number two is trend analysis. Number three is common size statement. Number fourth is fund flow statement. Number fifth is cash flow statement. Number sixth is ratio analysis. So these are the different quantitative techniques which can be used for analyzing the financial statement and financial position of the business. In comparative analysis, two types of the statement is prepared, that is comparative income statement and comparative balance sheet. In trend analysis, 1 year has been taken as a base and other 10 percentages are calculating on the basis of 1 year. In common size statements, two statements are prepared. Number one is common size balance sheet and number two is common size income statement. Fund flow analysis and cash flow analysis used to see the flow of the fund and the cash from one accounting period to the another accounting period. And ratio analysis is used to analyze the financial statement from the different angle by using different types of the ratios. Next, we will discuss the limitations of financial analysis. So there are many limitations. So let us see. Number one, it is only a study of interim reports. Number two, financial analysis is based upon only monetary information and non-monetary informations are totally ignored in this. It does not consider changes in the price level. And as the financial statements are prepared on the base of going concern, it does not give exact position. Thus, accounting concepts convention cause a serious limitation to financial analysis. Changes in accounting procedure by a firm may often make financial analysis misleading. And analysis is only a means, not an end itself. The analyst has to make interpretations and draw his own conclusions. Different people may interpret the same analysis in a different way. So, in this way, these all are the various limitations of the financial analysis. Financial analysis actually is a powerful mechanism of determining the strength and the weakness of firm, but the analysis is based on the information available in the financial statement. Thus, the financial analysis suffer from serious inherent limitation of financial statement as I discussed above. So, so the reliability and the accuracy of financial statement analysis is based upon the accuracy of the financial statements. So, in nutshell, financial statements actually are prepared for decision making and they are playing a dominant role in setting the framework of managerial decisions. But the information provided in the financial statement is not an end itself, so as no meaningful conclusions can be drawn from these statements alone. The information provided in the financial statement is of immense use in making decisions through analysis and interpretation of the financial statement. So, financial analysis is the process of identifying the financial strength and the weaknesses of the firm by properly establishing relationship between the item of the balance sheet and the profit and loss account. There are various methods or techniques used in the analyzing the financial statements like common size income statement, comparative balance sheet, changes of schedule of changes in the working capital, fund flow statement, cost volume profit analysis, and the ratio analysis. So, I just conclude today's video with one of the definition given by the mayor. Financial statement analysis is largely a study of relationships among the various financial factors in a business as disclosed by a single set of statements and a study of trend of these factors as shown in the series of statement. Hope this video is very knowledgeable to all and you have understood all the concept of the financial statement and financial statement analysis properly. So there are many quantitative methods also used to analyze the financial statement to have accurate figures in the hand, so that decisions should be based on the accurate values that also can be used in the business. So with this, I'm ending the video. Hope you enjoy the video and learn some important details related to financial statements. Thank you.